Hi, welcome to Market Alert for Monday, the 11th of May 2020. So Wall Street soars as Main Street struggles with low rates, no jobs and more deaths. Wall Street is very much occupied, whereas the easing of the lockdown is seeing the shopping malls and shops unoccupied, even though there is a slight easing of the lockdown measures in the US. Also on Friday, of course, we had the non-farm payroll figures. The previous month were minus 800,000, and on Friday they came out at minus 20.5 million. Better than forecast, which was good for the market. It doesn't matter about the fact that 20 million people have lost their jobs. It was good news for the market. So here in the 5-minute chart, you can see the market's reaction. We sold off at the beginning, as I've said before, a lot of people taking profits at the start of the session, but we've got the usual trick here, as you'll see from the low to the high, which is here, takes you all the way over to 89% retracement, and immediately prices close back above the 200 bar moving average there, leaving the market free to move higher, as you see there. And then before the close, the plunge protection team are in and ramp the market up aggressively there. And then overnight, again, this continues. Why not? All of the money they're printing is finding its way into the markets. And overnight, we're already up 100, 200, 250 points before we start to see a bit of a pullback there by 100 points at the moment. So in the daily chart, again, we can see that prices are moving to the upside. I'll just expand this out a bit so you can see where we're at. And at the moment, prices have traded up to the 76% retracement at 24,521, or just a little bit higher, and have found resistance, which is why prices are pulling back at the moment. On Friday, we went straight through the 24,169 level, and overnight we took out the 24,300 level with no problems at all. On Friday with no problems at all, and then up to the 76% on the overnight. And this insanity is going to continue as the lockdown is eased, but eventually things will change. And the reason I say it's going to continue for the time being is that the implied volatility, the risk on the selling of options is heading back down to some lows of pre-pandemic lockdown there. You can see there 21, so 27, so that's heading in the right direction. And again, as we see here, one bank explains why QE no longer stimulates the economy and only leads to higher stock prices. Well, this has been going on since 2008. It's just the 1% that have continued to get wealthy, the bonuses in the banks, etc., etc., and that's where you've seen the inflating of the bond market, the stock market, and the housing market, which certainly the housing market is probably going to be the worst affected by this, as people struggle to pay their mortgages, their rents, etc., whereas they can keep pumping money into the stock market and the bond market. So the one bubble that is certainly going to be pricked is going to be the housing market for sure going forward. The bond market will also eventually switch, but that's going to take a lot longer. We think can continue to print money for both the bond and the stock markets and support these two. And also, just to clarify that, you'll also see here US depression, the greatest depression, not Great Depression, the greatest depression. The V-shaped recovery fades away. Central banks are massively injecting liquidity, but a solvency crisis is not solved with more liquidity. As Einstein says, madness is repeating the same thing or doing the same thing time and time again, expecting a different result. We've already seen this for the last 12 years since 2008, and then on September the 18th of last year, the liquidity dried up in the repo market, and 75 billion was printed overnight for many, many months, until eventually we got to February, where there was 325 billion a night being printed, and repos extended to 48 days to repay And then fortuitously, as Jim Sinclair said in his video interview yesterday with Greg Hunter, which I highly recommend, the first 5 minutes are absolutely stunning in his explanation of how fortuitous that the virus was, that it actually turned up. I'll put a link in the description for you. It is really worth watching, because had this virus not turned up, the financial markets would have collapsed. And he explains why this is the case. I'm not going to spoil it for you. I'll let you have Jim tell you exactly what's gone on there. So yeah, that's where we are at the moment. So let's have a quick look, see if we've got any major news this week. I don't think there's anything out that is major, but let's have a quick look as it's the start of the week. No, so there's nothing for today. Tuesday, we've got Powell out on Wednesday, and Crazy Bailey's out on Thursday, and that's about it. We've got retail sales for the US, but not a lot out for this week. So apart from Wednesday and Thursday, we have a couple of central bankers. Okay, that will do it for this one. If there is anything else to report, I will let you know, but take a look at Jim Sinclair's interview. Absolutely brilliant. He's been in the markets for, it must be getting on for 65 years. What he doesn't know about the precious metal markets isn't worth knowing. And he also, as you'll see from the interview if you watch it, he owns gold mines and all sorts of other things as well. Very interesting man. Very good at predicting the price of precious metals as well. So take a look. But certainly the first 5 minutes are well worth listening to, because of the explanation of why the coronavirus was fortuitous for the financial system. Okay, that will do it for this one. If there is, like I say, anything to report, I'll let you know. But otherwise, as ever, thanks for watching. See you in the next one.